This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome back to the Fintech Takes podcast. My name is Alex Johnson, and I have a very special guest episode of the Fintech Takes podcast to bring to you today. My longtime fintech friend, and really just friend, I think, if that's fair to say.
It's more than fair.
Mary Wisniewski, formerly of American Banker, now at my old employer, Cornerstone Advisors, where she is the editor at large, the host of an amazing podcast, which we're going to talk about, writer of great fintech thoughts. Mary, thank you for coming on. This is so fun.
Alex, it's already a pleasure. Thanks for bringing me on.
Oh, of course. I feel like you and I have done a version of this conversation, 20 times over the last however many years we've known each other. So this is just going to be like the next chapter in a long-running conversation that we have. But the thing I always think about when I think about you and the work that you do is I don't think there's anyone better in the industry at talking about the human side of fintech than you. And
thank you.
Well, thank you, because I think that it's something we lose a lot, right, in discussions about fintech. I mean, lately I've been very deep into like regulation and the sort of legal side of fintech for obvious reasons, and business models and getting deep into different technology things. And all of that is important, but everything we do in fintech and in financial services broadly is in service of helping people. And so I do think sometimes we lose track of that a little bit. And anyway, I have a bunch of different topics, much of which relates to work you've done over the last 6 months or so that kind of focuses on the human side of fintech. So I thought we'd have a sort of human-oriented conversation about some things that are happening in fintech right now. Does that sound okay?
Yeah, bring it on, Alex.
Okay. All right. So I want to start with this subsection of the podcast titled, Are the Kids All Right? And this is based on research that you published at Cornerstone on Gen Z. And I'd love for you to kind of walk us through the research you did and some of the main findings, but I will throw one small lens on it, which is that, I don't know that I've ever asked you this, but I think you and I are roughly the same age, come from the same generation.
Millennial, and
like probably can't pretend to be Gen Z. Like we're not on the border of like being Gen Z. Like we're like straight millennial.
If we're doing that, then we got a bigger issue.
Right. I like to think of myself as pretty squarely in the millennial category.
Yeah.
I can't sort of like pull the hoodie up and be like, no, I'm Gen Z. So I think I remember you saying something to that same effect when you were announcing this research report of you sort of felt like you got educated on Gen Z and learned a lot more about Gen Z than you had known before. So maybe to start, can you walk us through just like the research, what went into doing it, and then kind of what some of the, I guess, key takeaways were?
Yeah, so Cornerstone partnered with a fintech company called Fritch, which is, yes. So
that's Rich, I know them, yeah.
Evan Rich. And they're trying to build community of Gen Z users and make it less taboo to talk about money. And that, filters to their credit union or potentially bank partners. So they have their data, and then Cornerstone has data as well. So we looked at that. But what was really interesting, Alex, is a part of this effort was Fritch did some video interviews with like college students and recent grads. And so I'm going to start there because you brought up the human element. And to me, what was really striking, or, it's sort of expected, but it's also striking when you visually see it and you see a student from their college dorm talking about how much anxiety they have about money. But I think what gets lost in a lot of meetings of bankers or credit union people, or maybe even fintech, it's just like dismissive of the younger people, thinking they're like, I don't want to say idiotic, but kind of. And I think, it's just this age group that is like thinking about money in a way where I don't remember really thinking about money. I certainly didn't go for a job originally that was tied to lots of money. But it's like they're thinking about, how do I get that first job? When I get that first job, how am I allocating my paycheck? What are my friends doing? How do I afford that fancy dinner that my friends want me to go to when I can't really pay for it? And of course, what's different about Gen Z is that they grew up on social media. They grew up on using Venmo. And so there's just more of a natural use of fintech among the younger adults. But I love how bold they are. I love how bold they are with their self-care days. I love that they're like sharing their salary information.
Yeah.
I just read a story yesterday where they're like talking about their debt, like on TikTok. This is how much debt I have. And that is a remarkable change, I think, because it's not usually what's talked about.
No, I could not agree more with that. I mean, so thank you for walking us through that. And I love that this research report, which everyone should go to Cornerstone's website and download, you can get it for free because it's really, really great. One of the things I love about it is it does combine those different types of data, right? So obviously you guys have lots of consumer survey data. Our old friend Ron Shevlin maintains a pretty robust collection of survey data to sort of have a pulse on what consumers are doing. But it's interspersed with that data from Frisch and that data that comes more qualitatively through those interviews that they did with Gen Z consumers. Because I do think sometimes, there's interesting nuance that hides in the quantified data that doesn't quite come out unless you do those interviews or that sort of qualified look. There was a quote in the report, see if I can find it. The word that keeps popping up into my head when I think about money, I guess, is that sometimes it makes me afraid. And I think that's such an interesting point. And again, something that, to your point about like banks and credit unions, I think executives at banks and credit unions don't always think in these terms, but it's hard, right? Like we all work in financial services. We've all, for the most part, gone through a lot of experiences working with banks, working with credit unions, working with fintech companies. We have credit scores. So like, I think when you get to a certain age, financial services just makes more sense to you based on your experience and your knowledge. And it becomes hard to remember that, honestly, nothing in financial services is intuitive at all. You know what I mean? Like, I always go back to credit scoring and sort of the credit report system, because that's kind of where I started my career. And I remember I taught credit education in high schools to people who are now old and are millennials now. But, back then, like, they were in high school and they had these really, like, sort of simple questions about, well, like, how do I get a credit score if I've never had credit, but I can't get credit unless I've already had credit? Like, that doesn't make any sense. And like, you have to be like, yeah, you know what? It doesn't make any sense. There's some ways around it. This is typically how people sort of deal with that. But I think we sort of don't appreciate how scary and unapproachable and unintuitive financial services is to someone who's never navigated it before. But that was definitely one of the things that jumped out to me reading this research, was like the level of like, I don't know how any of this works anxiety that seemed to be sort of on the minds of Gen Z.
Yeah, I think that's a really fair point. And it's totally true. It's because it's just like, what is your starting point? I don't know. I think I referred to it as like the financial coming of age story, which of course we all sort of mean, but it is really overwhelming. And if you think about the price of rent right now, like that credit score matters even more because rent is ridiculous. So like to just like emerge out of school and then have to pay exorbitant rent, even if you have roommates. I mean, that alone is daunting.
And it does bring up another interesting point, which is I was just reading a book called Generations by someone named Jean Twenge, who's sort of the leading authority in the U.S. on the differences between different demographic generations, right? So she has this massive data set and she's studied everyone from the silent generation down to Gen Z and then consumers who are younger than Gen Z who are coming up after that. She, I believe, calls them Generation Polar, which is interesting. But one of the things that she looks at that's really interesting is this question of how different are different generations really from each other, right? Because I do think we get wrapped around the axle sometimes, I think, in financial services on, I remember this with millennials because it was my generation, people being like, oh my God, millennials are so different. They don't want the same things. A big one that always comes up every like 15 years seemingly is, this young generation, they don't want credit cards. They hate credit cards. They're not using credit cards. Look at the numbers. They're using debit cards and not credit cards. And then what happens inevitably is when you go from being in your early 20s to your early 30s, suddenly everyone starts using credit cards because actually credit cards work really well. They're rewarding. They facilitate shopping or maybe over shopping in a way that's appealing to all generations, regardless of how old you are. And so the credit card one is always like this trap where you're like, actually, they're not different fundamentally than older generations. They're just younger right now in their lives, and credit cards don't make sense for them yet. So the question that the author of this book, Generations, sort of asks and tries to interrogate honestly is, what are the examples where these generations aren't actually that different? It's just these are young people and these are older people. And where are there actual, real, meaningful generational differences? And, to your point about like the affordability, that's a big topic, right, with Gen Z. And I think it's something that's causing seemingly a lot of anxiety with younger consumers. Like, am I ever going to be able to buy a car, buy a house? Am I going to be renting forever? Can I afford to live in this city? Like, affordability is like a very, very big topic. And what's interesting is if you look at the actual data in terms of like income disparities, inflation, the buying power of the dollar adjusted for inflation, Gen Z is actually not that unique relative to other generations. And the example I always go back to is, when I got out of school, interest rates were very low, right? And so I was not that houses weren't expensive, they were, and houses have continued to get more expensive, but like mortgage rates were pretty low and I was able to buy a house. And I remember kind of complaining to my parents at the time, like, man, houses are so expensive. This is ridiculous. And I remember them like laughing in my face. And I was like, what? And they were like, well, when we graduated college in the 1980s, interest rates were vastly higher. They were even higher then than they are right now after we've gone through this interest rate increase. And they were like, rates were so high, no one could buy houses. Like houses were completely, even though houses were less expensive, they were still out of reach for all of us. And so I do think there are some of those things where when it's happening to you as a young adult, it feels like the end of the world or something that no one else has experienced, but the data would suggest that's not true. The flip side, though, and this is the thing I want to get your take on, Mary, is like this book I was reading that I just love. I'll drop the link in the show notes. One of the main theories they have is that technology always is evolving and getting better. And so one of the biggest ways that you can tell the differences between different generations and meaningful differences that persist over time as those generations get older is what technology they grew up with and how that shaped their attitudes about different things. And I think there were quite a few mentions in the report, and I'm wondering if you can kind of comment on like, seems like social media and growing up with smartphones and growing up with the ability to sort of always be comparing yourself to your peers and the pictures they're posting on Instagram or TikTok or whatever of like how great their lives are. That seems like fundamentally a difference between Gen Z and older generations that might persist. And it might be creating that anxiety about like, I'm worried I won't be able to get all the things that I want in the future. What's your take on that?
I agree that, there's so much universality to what people face, and we won't really know what's different until time passes, right? We're in the who knows what's going to happen.
Right.
Yeah. What we do know is Gen Z is a very diverse generation, more so than our generation. So that's one thing. And to your social, my gosh, can you imagine? That would have been my worst nightmare, having Instagram or TikTok in high school. I mean,
would have wrecked me. It was bad enough already, honestly.
I know. I went to like a high school in the Midwest. Pretty cliche. Jocks ran the show. Yeah, that would have been really awkward.
It would have been hard, right? It would have been hard.
Here I am with my book.
It's horrible. Yeah, I mean, I do very much have a lot of like empathy for Gen Z growing up in an environment where from whatever age, 10, 12, whatever it was, like I had a smartphone, I was on social media, and I was just taught to like constantly be comparing myself to other people. And one of the things that comes out in any sort of behavioral study or any sort of psychology study about what impacts human happiness is like comparison is the thief of joy, right? Like when you compare yourself to other people, you're almost always going to come away from that experience feeling miserable. And the ability for technology to make it easier for us to compare ourselves to each other, even if in sort of absolute terms, Gen Z is doing okay financially relative to earlier generations, it might not feel that way to them, which I think is a totally valid point.
Yeah, because it's the visuals too. It's like, seeing your social circle at, some fancy concert or traveling somewhere that looks amazing. But like, you don't know what's going on with them. They could be taking on tons of debt.
Yeah.
Or they might have family money or, who knows what it is. But I do think social media changes the way they are compared to other ages. And I also think, just living through a pandemic at some of your youngest years and being locked out of like, what have been viewed as quintessential things like prom and whatever. And that has an effect.
Yeah, no, absolutely. Well, and I think that, the question then, and this would be what I would hope that bank and credit union executives are talking about in meetings is, so what do we do? How do we help them? And, one of the things that I actually really like about Frisch and the way they've sort of approached solving this problem is I think a lot of it starts with helping younger consumers get a better handle on where they actually are and like how to think about their current and future sort of financial trajectory. Because again, like if you just rely on what you see on social media, you're going to come away with a very distorted view of like, oh my God, that person is younger than me and they're taking a vacation in Greece. Like, what the hell? I must not be like on track financially. And so having a more sort of honest and well-rounded conversation, and in the case of Frisch, like giving people a forum to be able to share information with each other about here's what's actually happening in my life. And even though I posted about this trip going to Greece, I also defaulted on this loan, right? And both of those things are a part of my overall financial life. Like creating opportunities to be more honest and to give people a sort of a fuller picture seems like a pretty important component.
Yeah, I'm hoping this is where the pendulum is shifting to this vulnerability because I'm interested in this. I haven't seen so many examples, but there is a notion, and Ron talks about this too, of like, can banking or credit unions like offer financial therapy in some ways?
Yeah.
Like that idea, because I think it's coming out ever more that like, money and mental health are deeply tied together. So when we're thinking about, everyone's dreaded word PFM, maybe we're also thinking about like ways to help people cope with, whatever mental challenges going on for them.
Yeah, I totally agree with that. I mean, I think that PFM, you and I probably are two of the more sort of passionate, longstanding fans and observers of the PFM space. Like if I
Alex,
think about,
did you have to try the tools though when you were first starting off? Because I had to try the tools on a journalism salary, and it kept saying negative, negative. Watch out!
I know,
you're going down.
Well, and like it feels like a lot of those tools were built for people who have great net worths that are going to show up awesome in those charts and those graphs, and mine was just like, So I definitely think that. PFM, and I've written about this before, but like as a category, it does need to evolve to address the emotional side of all of this stuff, right? Because the other thing, and I'm really fascinated by this, there's actually a lot of consumer surveys out there that suggest that consumers who are younger, so like early to mid 20s, they actually are very interested in conversations, even visiting a branch, which is insane to say, but like
I hear that too, and I'm like, is this study valid?
And you're like, are you serious? Yeah, but the thing that's funny about it is like, I think part of it is, oh my gosh, young people love technology, they love phones, they're always on their phones, they would never come into a branch, and there is some degree of that. Like I think to a young person, the way to solve a problem, the immediate first answer is always pull out your phone, go online, try to answer the problem that way, and that's different than older generations. But this kind of ties back into like what's different versus what's not different for generations. Guess what all young people have always wanted from financial services when they're first starting out? Help, guidance, someone to answer their questions, someone who will humor their dumb sounding questions that they're embarrassed to ask other people.
And that's a really important one because certainly the banker isn't usually delivering like a safe space feeling for a lot of people.
Exactly. Yeah. So I do think that, if you're a bank or a credit union or a fintech company and you're trying to think about like, how do we appeal to and help younger consumers, a lot of it is in that like guidance, benchmarking, ability to answer questions, ability to be vulnerable, and like wrapping those characteristics around the products that you're offering and, giving people different forums and different channels to look for that type of return. I mean, I don't know how many more times younger consumers, and now of course it's Gen Z, need to sort of say, I want help before we go, okay, maybe instead of giving you this self-service digital thing that we think you want, because we think we understand young people, maybe we should actually listen to what they're saying and go, you know what, they actually want help. They want to talk to someone. Maybe they're even willing to come into a branch if we can give them an experience that's going to match up with what they're looking for. And if that's the case, strangely, I actually think that banks and credit unions are fairly well positioned to do that because they have a lot of that infrastructure built already, whereas a lot of fintech companies, digital is kind of the only way to engage, and you have to find more creative ways to do that.
Yeah, and I think you could do like a fun community event. I mean, you probably have to bring in some outside talent, but like it's totally possible. And you're speaking to like this retro thing, which is, again, it's so many people, but like Gen Z, you hear stories, and even someone in one of the videos was saying how they to make sure they're saving money, they're physically putting it in a jar and like keeping it away.
That is
so
awesome.
I've also heard envelope budgeting.
Kind of
is
back
something that
a little bit. Yeah.
is coming back. Yeah. And I'm like, wow, that's really striking to me. And so, yeah, we'll just see how this all plays out. But it does seem like, again, if I'm comparing it to myself when I was younger, I certainly was not engaged at all with my money, except that it was small.
Right.
And I lived in New York. I mean, I lived in Brooklyn, but I was like, this isn't
going to work. Yeah.
This isn't going to work. But I do feel it. I felt it in the research. Like, there's this moment, and this would be universal. You get that first job, and maybe sometimes it pays well, but like often it wouldn't.
Right.
And so, but it's still going to feel high to have a full-time job, if you get a full-time job, which of course is also changing. But you think you have all this money, but then it hits and you realize, oh, well, all these bills too. And like, it's actually maybe not enough.
It's a rough education, right? And I think that, to your point, like, everyone goes through it, but there are times when I think like we've kind of abandoned Gen Z a little bit, just from like a product perspective, because so much of it is, say no more. I know that you're 22. Here's our app. Go have fun. And like, they're like, oh, okay, great. But what they really like maybe want is more help and more access to those sort of more older established techniques for learning about this stuff. And so there is something to this idea of like, what's old is new again, because eternally people who are at this stage of life just have these challenges.
Totally. And I would say one recommendation for the industry is check your arrogance, because something we faced as millennials was, of course, like getting all that garbage content of like, don't eat your avocado toast.
Totally.
And I did see in the Wall Street Journal today that millennials, aka us, are doing A-okay.
Yes, it turns
I wouldn't
out.
really personally say that, but I mean, better than then.
Yeah, no, I mean, it's funny, right? Because like, I do think the macro sort of economic and technological forces are making things better for every generation. Yeah. And so, it would not at all surprise me if, to your earlier point about once we can fast forward the clock and see with the benefit of hindsight what happened, I wouldn't be at all surprised if Gen Z turns out to be, the richest and most well-off generation in history, right? I mean, like, from an overall macro trajectory, that's the path they're on. But the question is, how do we help them manage their anxiety and the sort of specific challenges that their generation faces as they are on that path? Because again, and this is a thing I've written before, the purpose of all the stuff we're doing here is to make people happy, right? And so if people end up in an okay financial situation, but they're incredibly anxious, they have kind of a screwed up relationship with money, they're not happy, then even if they ended up in a place where they have a decent net worth, it's still not really getting to the core human goal that we're trying to achieve by doing all of this. So I think that's a really great place to cap that. And now, Mary, if you don't mind, can we jump in the time machine and go sort of to the other end of this continuum?
Yes, and I have the perfect segue before you do that.
Go.
One thing about Gen Z is that this is, when I worked at Bankrate, one of my colleagues was doing this, and then it turned out it was a big trend. They use AARP cards for discounts.
Really?
Because it's not an age cap. So I think that shows some savviness.
It does.
Yes, and takes us to the older ages.
It does. So I wanted to talk about the other end of the market, which apparently is linked together by AARP cards, which is hilarious. Older consumers, and we'll sort of bracket this in just a very general way by saying, let's just say like over 62, right? Something in that sort of general kind of early retirement age. And I think I actually saw you did a podcast recently with, was it the head of product at Charlie, the neobank?
Tony.
Yeah. And
which is based out of LA. Mm-hmm.
Based out of LA. And so, everyone should go listen to that podcast episode. And one of the things I think that Tony was saying in that podcast was that something like 10,000 Americans a day are retiring, something like that. And so we're kind of having this like boom moment. And we knew this was coming because the baby boomers are a very large generation. But this segment of over 62 retired, this part of the market is getting a lot bigger. And so I've been fascinated and honestly pretty encouraged to see more Fintech apps like Charlie, Careful. There's a bunch of ones that have come out recently that are specifically building solutions, financial solutions for older consumers. So can you give me a little insight just based on your conversation and your look at this market? Like, what's being built in this space and like, what are some of the key challenges that we're trying to solve for here?
Well, this is where it gets really sad, but, with the older adults, still struggling with money and, you're not getting income boost usually in the older years. And so it's like, whatever you have is whatever you have.
Right.
But, it gets pretty sad. It gets to the point where like, can you afford these pills kind of thing? So Charlie, I was so excited when Charlie launched, I don't know, was it last year or something? I remember I was like, I have to blog about this. And I was slightly late to it, but I was just like, I love this. I love that there's entrepreneurs building for this. And I know there are other examples as well, but I think, there's this assumption in the industry that like, hey, we already got the older people. They're our customers. They're our members. But there's a lot to be developed, I think, on the tech side for this particular audience. And with Charlie, the thing that they had just launched, I think it's called Speed Bump, but it's like slowing down the payment when you're sending money to a newer contact. And it slows it down by 6 hours, but it will still send it through. But it gives you that pause in case you're getting scammed, because it's such, the older adults are so targeted by predators.
That's exactly right. And I think that, safety is probably the number one word that would come to my mind when I think about what are the unique financial challenges that need to be solved for older consumers. And you're right. It is to our great shame as a society, I think, that the amount of elder fraud and abuse that exists in the world is as much as it is. And it's awful. And I think the challenge when you compare these newer fintech solutions that are being built with this particular segment in mind versus, why can't, obviously most older consumers are probably going to be banked to some degree. They'll probably have a relationship with a bank, could be a community bank or a credit union or a large national bank, but like they've had a robust, probably relatively full banking life. And so like, why can't we just continue with that? And I think part of it is that, to your point, as you get older, the amount of money that you have kind of crystallizes, right? You might have a reasonably large number of assets, but you're not going to make any more. And, obviously there's Social Security and retirement and stuff, but that varies a lot depending on the individual, what their expenses are. And so you have sort of a fixed pool that you have to sort of manage carefully. And that pool is under assault by all of these scammers and fraudsters and others. And the speed bump feature is such an interesting one to me because I think I've said this multiple times, speed in payments is really a double-edged sword, right? And the ability for someone to fall victim to a scam where they are authorizing a payment and that money moves instantaneously. So let's just use like Zelle as an example, because the money in Zelle moves instantaneously. Older consumers, I think, are probably more likely to have Zelle, actually, than they are Cash App or Venmo, just because Zelle is offered through banks. So I would say Zelle's probably overrepresented as a tool among older consumers relative to other forms of P2P payments, which is unfortunate because Zelle is also the only one that operates in real time by default. Like when you send that money, when you authorize that payment, it's gone. And according to sort of existing regulations, and these might be changing, but according to existing regulations for Reg E and the Electronic Funds Transfer Act, when you authorize that payment, you are not eligible for a dispute and for being able to dispute that and get your money back, right? If you authorize it, it's not fraud, it's a scam, and you're on the hook for it. And I think that poses a huge challenge to older consumers. So I really do love the idea of designing more thoughtfully, like, here's a speed bump here, here's a little bit more education here, and even getting to the point where, like, I've seen some of these solutions where it's kind of a co-banking experience that's built for older adults and their adult children to kind of co-manage. And there's sort of it's almost kind of like Ramp a little bit, where it's like, the employees have the cards, but then there's a level of sort of oversight and controls sort of wrapped around it. I think all of that is so essential for this segment.
Oh, it is absolutely essential. But this also brings us back to the younger age as it does to this age. It's like you have to overcome shame.
Yes.
So,
yes.
Like shame when you're young to be like, I have so much debt. Can I do this?
I have a dumb question about this. I don't know how this works. And then, when you're older.
Yeah, when you're older and you've been your money's been stolen from you in some scam that you fell for, and you're going to be embarrassed. So maybe you don't even report it, or maybe you don't even tell your adult child. And so like it's a hidden thing that happens a lot, because the thing I'm most hopeful for is that we start just getting over this shame of all these things, because mostly they're universal. It happens to so many people.
No, I'm so glad that you brought that up. And again, this is why you're our human fintech correspondent, Mary, because
I'm the humanities side of
it's awesome.
banking.
It's awesome because, I mean, shame is exactly the right word, right? And I've heard that same thing. I was talking to someone who works at a large nonprofit that helps consumers sort of deal with scams and when they are the victim of fraud. And that person was telling me that, yeah, the number one issue is underreporting because people are ashamed that they fell for it, right? And that it seems so obvious in retrospect. And,
yeah. And then you think it's like a side effect of just being older. So maybe you want to mask that a little bit.
Right. And like, yeah, when we were just having this whole conversation as a nation on the political side, but like it's a really hard conversation to have. Like, have you lost a step? Is that okay? What does this mean? Like, how does this affect my autonomy? And so there's a whole set of really thorny issues. And I felt for a long time like the thing that fintech is getting really good at, and this is why I am very cheered by the fact that there are more fintech entrepreneurs building in these areas and not just building, another whatever BNPL solution or credit card or whatever. Like build cool stuff in new areas. This is a great one because you have to sort of infuse software with an understanding of how to help people manage tricky emotional situations, right?
Yeah.
And so, like, in this particular case, how do you build a software solution to help adult children and their elderly parents jointly manage their assets in a way that preserves the autonomy and dignity of really everyone involved, but also make sure that the assets are being protected, that good financial decisions are being made. And like, how do you manage that in a way that's like graceful and respectful and sort of orchestrated through software? Like, that is an incredibly difficult challenge. But again, the thing that's nice about fintech is the right fintech founder looks at that and goes, there's a way to solve for this, or at least to make it better.
Yeah, I think so. And again, it's got to cut through a lot of stereotypes because you still see tons of like, even on bank websites, the retirement page would be like an older couple walking on the beach or something like that.
Right.
As if that's the best case scenario. For me, I mean, yes, that sounds great. But like, just, that's such a cliche. That's a cliche thing.
No, it is. And it brings me to a rant that I want to rant about briefly, but it is a really good point.
Rant away. Yeah.
So I have lately, through my newsletter, gotten the opportunity to connect with a lot of older sort of fintech experts, right? So people who've worked in the industry for a long time. And these folks are anywhere from 50 to 70, let's just say, or 75. And not old, prime of life. Like 50 is the new 25. Like, I mean, these people are sharp. They have really great experiences in the industry. And one of the things that they're finding is that fintech companies won't hire them. Like, not for the life of them. They can't get a job in any fintech company. And so I think to your point about like assumptions and biases, we do have this like single sort of mental model for, this person is older. That must mean that they don't want to work anymore, which in the case of several folks I know personally, including my dad, is not true. Like, they're going to work for a long time. They get a lot of enjoyment out of work. They're maybe not as sharp as they used to be, or they don't really know anything or have the ability to deal with technology or to understand what's happening. In fact, I think if I'm remembering back to your podcast, that was one of the big misconceptions that I think people have about older consumers is that they're completely and utterly technology illiterate, which is not necessarily true.
No, it's not true at all. I mean, like, I think it's held decade after decade. Oh, this is how it was. But like, it's changing. People who are 62 today are different than the people who are 62 10 years ago.
Right, exactly. Like in the same way that, Gen Z are a different group of, 20-year-olds than, Gen X when they were 20. Same thing applies on the other end of this whole process when, today's over 62 consumers are very different than older consumers were 50 years ago. So I think appreciating that nuance and building for that nuance is kind of what I'm hoping to see more of.
Yeah, no, definitely. And I'm glad you brought up the like hiring this kind of talent, because I guess I fast forward in time to like, honestly, my funeral, Alex. I'm like, oh, I think I missed a few milestones along the way.
Now we're getting dark. Yeah, talking about getting dark.
We're getting dark. But I'm like, and then ageism is going to happen. And what am I going to do for work? My retirement's not good enough, blah, 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 blah. And then I get so mad. But I'm also mad just for people having to deal with that today. Because like ageism works in all different directions. It's against the youth and it's also against older adults. But the thing about like a fintech company, perhaps, hiring someone a bit older, they're also going to know some of this clunky technology too, perhaps, and can help them solve really important mysteries. There was a company, I might get this name wrong. Have you heard of something called Is it the Cobalt Cowboys?
Oh, yes, I have.
Okay. And then they go in, they're hired by a bank or something to like go understand that technology.
Yeah, this was like basically people who know COBOL, the programming language, which is like astonishingly old, but is used everywhere. It's used in government websites. It's used in banking a ton. And, say what you will about COBOL, but it's bulletproof. Like, it doesn't break. And so no one wants to rip it out because it's like really solid code that works really well. But the problem is most of the people who know how to program in COBOL are dead or are getting older or retired. And so, there's this group, COBOL Cowboys, that exist to basically get hired as consultants to come in and like, if you need to touch the COBOL code in your systems, we'll come in and do that, right? So it is like probably an overly dramatic example of this larger idea, which is, older consumers have a lot to contribute, right? And so this idea of like, you're on your way to the nursing home and that's the only mental model we can use to build products for you or to think about you, that's not a very good model to use. I mean, I'll give you another example, and I'm just kind of working off the cuff here, so maybe this is stupid, but like, here's another thing I'd like to see. We talk a lot about younger consumers are very sort of oriented around like charity and nonprofits and giving back. And so you see a lot of like fintech and other sort of adjacent software get built to help like young consumers donate more money or to like live in a more sort of philanthropic way. Why aren't we building that for older consumers? Like, can't you imagine a world in which there's a bunch of people who are retiring who have pretty good sizable assets and who have never thought before about how they're going to dispose of those assets and what they want to do with them, and have no infrastructure or expertise or knowledge in how to give money to philanthropies, to give money to charities? Why aren't we building into these over 62 banking apps and fintech apps better like charitable giving and estate planning functionality that would really empower those consumers to figure out exactly what they want to do with their assets? Like, I don't think we do that very well either.
I agree with you. No, and that's a beautiful idea.
So it's just like when you start pulling on those strings, it's pretty easy to come up with like, well, they need this and they need this and they need
all
this.
This idea.
Yeah, I'm very excited for this.
Yeah, me too. And I guess I would encourage the audience to check out the Substack called Oldster. Okay. It is not about fintech specifically, but it has people of all ages. So it's called Oldster, but you could be in your 30s, 20s, 50s,
Well, I like
70s.
to think of myself as an old soul, Mary. So.
I am as well, Alex. But they do a questionnaire of like, what age are you and what do you feel? And it just really explores the like things that might be the gaps in the industry of like what you're not thinking about for this age. And it is really like from a writer standpoint, It's just really refreshing to read it.
Oh, that's awesome. All right. So, Mary, I want to wrap up with one last topic, which is one I've actually been dying to get your take on and should have had you on the podcast a long time ago. That's my fault.
Alex,
that's my bad, Mary.
You?
I am so sorry. I'm so sorry.
I've been writing about it in my diary, Alex.
Oh, stop it. All right. So here's my question for you. In the wake of Synapse and everything that has happened in banking as a service, putting on your humans in fintech hat, what do you think the long-term impact of that will be on people's trust in fintech? Because I think you can talk about brokered deposits and you can talk about third-party risk management and all the sort of technical aspects of that. But to me, the most important question is, how does this affect trust?
This is such a big question, and I'm sure I'll change my mind as time goes on. But I think it probably only really affects the trust of those who suffered during this. Because one thing I learned working at Bankrate was like, most people just don't care about this stuff until they have a problem. And then they're going to care a lot because, of course, the highest stakes are money and access to your money.
Yeah.
So I think long-term trust for anyone who is affected, that's like, oh, you're not going to want to use fintech.
Yeah, like if you kept your money in Yada, just as an example.
Yeah, if you kept your money in Yada.
And it's been frozen for this whole time and you can't get money and you're missing bills. Like, I mean, you can read the stories online. Like, they're heartbreaking, right? In terms of like people losing their homes, people having to like live on the street, people having to take out a bunch of really predatory debt to keep paying their bills. Like, it's awful, awful stuff. Why would you ever trust another fintech app again? I really don't think that's going to happen for these consumers.
I don't think it's going to happen for these consumers. And even for the low stake things, like bringing it back to like when you're young, when you're take your first job and you go on your first traveling experience for the work trip, and like maybe you have a credit card, but maybe you don't. But I think what gets lost even with that is like your employee can't afford this trip to float it. And so that's just like smaller amounts of money, maybe a few $100s. But here with people like, having sizable amounts of money at times in these accounts that they can't access, I mean, that's just the worst thing that could happen. Now, but for the broader audience, again, I just don't think they're paying enough attention to like, oh, it's this risk, it's that risk. Usually, like if you're signing up for a fintech app, it's because you want to solve some issue you're up against. So like, here's a thing that was going down a few years ago, and I'm sure it still is. People were stacking the early payday apps. Yeah. And so that's not good, but it's like they're doing that because they have that need, financially speaking. So I think what we're just going to see, trust or not, like people are going to do what they need when they need to do it, just like payday lending.
Well, I'm glad you mentioned that too, because I think the other thing that's interesting here is there is a distinction between different categories of products, right? And so to your point, like, is someone going to trust getting a loan from this provider in the future? Probably yes, in a lot of cases, because if you need liquidity, you need liquidity, right? Like payday lending still exists, even though everyone knows it's horrible, because when you need money, you need money. So I think you're right. Like when you need liquidity, the fact that, oh, this is a fintech company and I haven't really checked to see if they have the appropriate state lending licenses and blah, blah, blah. Like, that's not going to enter into your calculation. Similarly, I actually think on the other end of the continuum, a lot of consumers learned a hard lesson with crypto, right? When crypto melted down and there were all of these sort of problems. And, I have a certain amount of empathy for that. But at the same time, I think the crypto dynamic was, there was kind of a get rich quick aspect to it all, right? And so like it was, I think, fairly clear on an intuitive level that this is a risk you're taking. Like if you're jumping into this, and not that I want bad things to happen for you or for FTX to like, invest your money in islands in the Caribbean or anything, but like in general, if you are really putting a big bet down on crypto, you probably had some sense that you were taking a risk and trying to hit it big. And so I think that, consumers probably won't necessarily learn an enduring lesson on the investment side either, because there's always going to be a temptation to try to like strike it rich and try to like beat the market. So
there will be a temptation. And I'll say there was an interest in LA in particular, during proper lockdown of the pandemic. There's all these artists who can't get work. And there was near me, there's this like quasi dog park, and it just popped up with all these first time crypto enthusiasts. But they just thought this is their ticket out of their lot in life currently. And it's just so sad, because then, it's just made their life a lot worse.
Totally. No, I think that's exactly right. And so, you can kind of separate these things. The thing that makes the Synapse stuff unique a little bit, maybe to me, is that this is like a bank account, right? And so the thing I struggle a little bit with this one is, and I hope maybe this won't happen, but I hope maybe consumers who weren't affected still take like a lesson from this, is if you're just wanting to keep your money somewhere safe, like you have no risk appetite for that, right? Like deposits have zero risk appetite. It's not like, oh, I know crypto's a little dangerous, but there's this big upside that I'm chasing. Or from a lending perspective, I know the terms aren't great, but I need money because I have to pay these bills. Like deposits is different. Deposits is, I just need a literal safe and accessible place to keep this money. And the thing I struggle with there is, and I'd love your comment on this, how were consumers supposed to tell that like Yada wasn't safe? I probably could have figured that out just based on my knowledge of secret banking as a service things that the average person should never have to know about. But like if you're just an average consumer comparing different products online, and like you used to work at Bankrate, right? Like comparisons of all these products, they're all right next to each other. They kind of look the same. Like how are you supposed to tell what's good and what's bad?
I don't know. See, the fly is coming around me as we bring on this topic. I don't think it would be obvious at all to a consumer, even a consumer trying to find out, because they're going to see like the FDIC insurance sticker for whatever reason, and it's if they're even looking. Because I'll tell you one thing, working at Bankrate, the handful of years, you see what evergreen articles get the most traffic. And so it was SVB that brought so many readers to click on something like, what is, FDIC insurance or something like that.
Right.
That is not standard. That is not normally what people are going for. So it's usually in the wake of a crisis, then what is insurance policy matters. So there's a resurgence of interest, but that it's not there all the time. And I imagine that would be true of fintech stuff.
No,
too.
I think that's exactly right. I mean, I kind of go back to, the whole sort of like, how much should we apply buyer beware is kind of the question we're asking, right? And so like with a lot of this stuff, like, with scams and fraud, like, oh, sorry, you lost all your money, but buyer beware, oh, you took out this loan and it had sort of unpleasant terms, buyer beware. Like, where is it appropriate to have some of that buyer beware? Because I do think there is an element of like, sometimes you have to learn hard lessons and that's the way you learn. So I'm not totally dismissing buyer beware, but the thing that bothers me about it is it's just, I don't think reasonable to expect people to do an insane amount of due diligence on everyday things, right? Like we go to the grocery store and we sort of assume that the food that's on the shelf was made in a way that's safe and isn't going to poison me. And that's not irresponsible of me to just pick something off the shelf without doing my due diligence of going to the factory where that was made and doing a quality assurance check on all of the things they're doing. Like, we have the FDA for that. We have a whole ecosystem that exists so that I don't have to think about the food I'm buying in a grocery store. And I think banking is kind of similar. It should be.
I think it should be similar. It's hard to pull off though, right? Like, because you can see reviews, you can see consumer reports stuff, but you'd really have to get into the disclosures to figure out what's going on. Even like, and this is not an example of a bad player, but I know some people are signing up for like a neobanking app to, let's say, get their tax refunds early.
Right.
But they're thinking they can transfer that money just as quick as it hits. And that's when they realize, oh, this actually took longer than if it just like went directly to the account. So it's like you don't know. How would you know? Why would you even Google that?
How would you know? How would you know?
Yeah.
No, I mean, I think that maybe this cuts against sort of our cultural image, but I actually think like American consumers are pretty trusting about a lot of this stuff. And I think that's a good thing. Like, I don't think it's bad that we're not like cynical. I think, the fact that, the FDIC in a lot of ways is a victim of its own success because it's been remarkably successful at making banking feel safe to consumers. Yeah. And so, you add this sort of fintech layer on top of that, which creates all these complications. And that's, what we've been talking about with banking as a service. But that's not evident to the consumer. They just see, FDIC member somewhere on the website. And honestly, like, if a consumer scrolls to the bottom of a fintech app's website and notices that it says FDIC on there, they've done as much due diligence as they could possibly be expected to do, in my opinion.
I think so. No, I think so too.
At that point, like, we have to take more responsibility for that stuff as an industry.
And if you think about it, it's really curious that people will sign up for some of these names are really random, like, oh, giving my money to this weird sounding name. But I think what's driving that is like they have that one feature that solves their problem indoor. Oh, my friend uses it. I'm going to use it too.
No, I'm glad you mentioned that because the one part of the Synapse story that broke my brain as a consumer individually was I sort of assumed that everyone else knew that there's a difference between like a Chime and a Yada, right? Like Chime, not a bank. Technically, a lot of these risks exist, but like Chime is a massive company. They have these huge teams that spend all this time thinking about how to make this safe. Like, I would have no problem recommending Chime to a family member to use and say, like, this is safe. But there's a whole other second and third level of fintech. And it's not these companies' fault necessarily. Like, when you're a young startup, you don't necessarily have the resources that a Chime has. But like, I was shocked at the number of people who were like, my life savings is in Yada. And to me, as someone who I guess has been too exposed to the fintech industry, when I heard that, I was like, oh my God, you kept your life savings in Yada? That seems insane. But you have to remember, if you don't have any special knowledge of fintech and like which ones are big and trustworthy and which ones aren't, they all look the same. And to your point, it's more about, I like the way they market this product. I like this feature that they have. This was recommended to me by a friend who really liked it because they had this thing. Like, it's the quality of the product that's drawing people in, not any associations with how safe or big or stable it is.
Yeah.
I think that's a good place to leave that one. All right, Mary, before I let you go, I have referenced several times your podcast, and yet I have not said the name of the podcast, which is, I have to tell you, my single favorite name that anyone has ever come up with for anything. So please plug the podcast. Where can people find it? What's it called? What do you do on your podcast?
Okay, so it is called Money Isn't Everything, and it's on all the platforms. And I named this. I was like, I don't know if this is going to go over well.
I want to know why you named it what you did.
I was like, okay, so I care about financial health, and I care about where entrepreneurs get their ideas. And I always hear people say, we don't want to be dumb pipes. That's me as a banker. Alex.
Yes, I could tell. You transformed there for a second.
Yeah. So I was like, this is a podcast that will explore everything that goes beyond just parking money. And then financial health being a major component of it.
I love it.
And it comes out every other Thursday. Next one will be, well, I don't know when this one will drop, but it will be August 22nd and then every other Thursday.
Okay. All right. Well, everyone should listen to this podcast. It's amazing. Everyone should follow Mary's work. She's frequently on Twitter. She publishes research at Cornerstone Advisors. She creates fun videos sometimes. So, Mary, we are all enormous fans of you, and thank you so much for being our human fintech correspondent. We'll have you back again soon, I promise.
I might need that to be my new title.
I can
talk to Steve Williams about that.
Yeah, I'll give Steve a call and tell him we need to change your title because I think that's it.
I think he'd be down. I'm like, that sounds like a promotion, Pat.
Well, we'll make it happen. Mary, thank you so much for coming on.
Alex, it was my treat. Thanks for having me on.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.